everyone, it's Caroline Piehl here from TimeWise Financial. I know it's been a few months since we sent out a market update video, so I wanted to send a short video addressing some of the common questions we're getting regarding the markets and the economy. Number one question is, will rates keep going up? Now, we don't have a crystal ball, but the Federal Reserve has indicated that they will remain data dependent. And what that means is for all of the future decisions that they have to make, they will continue to rely on the most recent data. And that still continues to be the monthly inflation reports as well as the monthly jobs reports. Now, if we go back to June of last year, if you remember, we were at 40-year high level of inflation, 9% year over year, which I'm sure we all remember feeling that at the grocery store, at the gas pump, if you're traveling on vacation. And inflation being at that 40-year high is the primary reason why the Federal Reserve raised interest rates so aggressively last year into this year. You know, we were at 0%, near 0% interest rates last year, and they're all the way up at 5.25% this year. So you've probably felt this if you're trying to buy a new home or buy a new car, and felt the effects of increasing rates this rapidly. But the good news is that these rate increases, or these ice baths, throwing this ice water on the economy to help cool the economy, have been working. The most recent inflation reports show that inflation was at 3.2% in July of this year and 3.7% in August of this year. Now, the reason for that increase between July and August is primarily driven by the increase of energy costs, with the price of gasoline going up over 10% during that time period. Key takeaway here is less about debating whether or not there's going to be another 0.25% increase throughout the rest of this year, and it's more about how long the Federal Reserve plans to keep rates at this high level. And so if they do raise rates again throughout the rest of this year, another 0.25%, they might not have to keep rates at that high level for quite as long. If they don't raise rates for another 0.25%, throughout the rest of this year, then they might have to keep rates a little bit higher before they consider reducing rates. And so we expect the conversation to shift away from if they're going to raise another 0.25% or not, more to discussing this plateau of how long they're going to keep rates at this higher level. So the second question that we've been getting is, when will rates go down? Now, again, we don't have a crystal ball, but if you look at history, it shows that the Federal Reserve comes in, and historically, they reduce rates during periods of economic decline. And one of the key indicators of economic decline or slowdown is the unemployment rate. The most recent unemployment rate came in at 3.8%, which is near record all-time lows. It is up, however, from 3.5% in July, which shows that there is some movement in the labor market. Now, we're sort of in this strange period where what might seem like bad news, where unemployment is going up, is actually good news. And the reason being is because with unemployment increasing, that indicates that the Federal Reserve, we might be nearing the end of these rate increases, which in the grand scheme of things is a good thing. Now, the Federal Reserve's main goal is getting inflation back to 2% and anchoring it at that 2%. And oftentimes that last mile can be the hardest. So while we're not completely out of the woods yet, there are a couple of silver linings that we want to draw your attention to with rates being high. Number one is that we're now earning attractive interest on our bonds. If you look at this chart here, you can see that when rates were near zero during the pandemic and during 2021, you can see interest rates here are less than 1% in some cases, the shorter the maturity. So you're getting pennies on the dollar for holding bonds. Whereas today, with higher interest rates, we're now able to collect 4-5% plus in interest on our bonds. And we'll start to see bonds contributing a much more meaningful amount to our overall performance in our portfolio. So that is a positive. The second positive of rates being high is that we now have a cushion built in. So if an economic slowdown were to occur, the Federal Reserve has tools to be able to stimulate the economy again by reducing interest rates. Whereas back in March of 2022, when interest rates were near zero, we didn't have any levers to pull to stimulate the economy. So now with rates over 5.25%, if we did see a significant economic downturn, the Federal Reserve can come in, save the day, and reduce rates to help stimulate the economy, as we've been conditioned to see in years prior. So both of those are two positive silver linings of rates staying at a higher level for a longer period of time. And the third common question that we're getting right now is, why shouldn't I just put all of my money or most of my money into CDs when interest rates are so high? And there's really no denying that CDs are paying really attractive rates right now. It's higher than we've seen in decades. But the key to that statement is the right now piece. So if we look at CDs and what they've paid over the last 5 years, if you see the chart here, you'll see that just 18 months ago, if you locked your money up in a CD, you would have locked in less than 1% interest, and you can't get out of it. Whereas if you locked it up 5 years ago, you would be getting anywhere from 2 to 3%, essentially keeping pace with inflation. And yes, today, CDs are paying somewhere between 4 to 5%, but as history has shown, rates don't stay at the same level forever. So there's a couple of risks with putting your money into CDs. Number one is reinvestment risk, which essentially means when you put your money into a CD, you get that rate of return, and you have to keep your money locked up in that investment until it matures. So let's say you lock in a 4.5% CD, and you run the risk of 2 years from now, when that CD matures, you are not able to reinvest that money at 4.5% anymore. You now have to settle for less. And so that is a risk that we want to point out, is the fact that you might not be able to reinvest your money at that same rate when the CD matures. The second key risk is during the time that your money is locked up in a CD, you might have missed the market's biggest rallies. So if you look at the chart here, you see that if you missed the best 10 days of the market over the last 30 years, so we're talking about just 10 days over 30 years, your returns over that time period would have been cut in half. If you missed the market's best 30 days over 30 years, you would have reduced your returns by a whopping 80%. So this just goes to show that it is impossible to predict the market's best days and the significant consequences of missing the market's best days, which is why keeping your money invested in a diversified portfolio is key. Now, this doesn't mean that you shouldn't put any of your money into CDs or a portion of your money into CDs, which it really depends on your risk tolerance, your time horizon, and your financial goals. But just as we continually talk about diversification in your investment portfolio, we don't want to swing in the other direction and put all of our eggs into one basket, CDs included. So what does all of this mean for you and for your portfolio? Number one is that we're continuously monitoring what the Fed is doing, as well as all of the different data points that they're taking into consideration to make their decisions. We're also considering the effects that their decisions will have on the broader economy, on the markets, and your portfolio. Number two is just keeping in mind the fine line the Federal Reserve has to walk. They are trying to cool an overstimulated economy without overcooling and pushing us into a recession. Now, the possibility of a recession is still there. It's still a possibility. However, what we've seen so far is that the consumer and the economy have remained resilient during these rate hikes. You also have to think about the stock market is forward-looking. It prices in 6 months from now what it expects to see, and we are seeing earnings expectations remain optimistic, as well as company valuations staying healthy. So those are also good signs. And lastly, we just want to emphasize the power of diversification, which does offer resiliency against these pending storms by not putting too many eggs in one basket. And also, it's important to remember that if your account is down or it goes down, you haven't lost that money. The moment you lose the money is when you want to cash out and pull the money out. That's when you lose the money. Think of it with your primary residence. Let's say your home value went down by $100,000. you haven't lost $100,000. You only lose $100,000 if and when you decide to sell your home at that lower value. So the same is applied to your investments and is another important thing to keep in mind during volatile markets. And as always, if you have any questions regarding the markets, the economy, what you may be hearing, what you may be seeing, or anything regarding your portfolio, please do not hesitate to reach out. We'd be happy to discuss with you. Thank you.